Good evening, everyone, and welcome to tonight's webinar, Tax Time Made Easy, Save Money and Time, this EOFY. We're glad you can join us this evening and go through this exciting topic. We have a couple of great guest speakers from Cutcher Neale to take us through the presentations. But first, I'd like to do an acknowledgement to country. We acknowledge the traditional custodians of the land on which we work and live. We pay our respect to elders past, present, and extend the respect to all Aboriginal and Torres Strait Islander peoples today. My name is Kathy and I'm the membership lead at AMA Queensland. I will be introducing our guest speakers from Cutcher Neale a little bit later. Just some housekeeping notes. The presentation will take about an hour this evening, with plenty of time for questions at the end. However, we notice that we have a chat box. Please put your questions there. We have muted our guests while we go through the presentation, but please keep those questions coming in to get the best out of the evening. We've also taken your questions on board that you sent through prior. We'll have an opportunity for those questions to be answered at the end of the presentation at question time. Please note, with our partnership that AMA Queensland has with Cutcher Neale, our members get a free 1-hour consultation with them. It is very important to take note of this because everyone's financial circumstances are different, very personal, and if we don't get to the depth of what you need, that once again, you can certainly take the advantage of this free consultation with our platinum partner, Cutcher Neale. Before we get onto the presentation tonight, I would like to mention a few of AMA Queensland's events that are coming up. On Saturday the 24th of May, we have Building a Private Practice, Essential Steps to Build Your Business. This in-person event will be in Brisbane at Victoria Park. This one-day event is designed to introduce medical practitioners to considerations of establishing and running a profitable private practice. And AMA Queensland has gathered industry experts to equip you with essential knowledge and for business success. We also have our private practice refresh strategies to grow your business. This seminar will help you gain the knowledge and tools needed to build a thriving and long-lasting practice. The event will be held in 3 locations: Brisbane on the 20th of June, Townsville the 18th of July, Gold Coast the 5th of December. Our Junior Doctor Conference will be held on the Fraser Coast on Saturday the 17th and Sunday the 18th of May. Our AGM and Black Tie Gala event for doctors, Dinner for the Profession, will be at the Star Brisbane on Friday the 30th of May. Come celebrate with close friends and colleagues or expand your network as you mingle and connect with new colleagues. This year, our International Annual Conference will be in Vancouver, Canada, from the 21st to the 27th of September. This year's theme is Innovation to Impact, Advancing Healthcare Together. We have plenty of other events that are coming up for this year. To find out more about all our events, please visit our website and go to the events page. We also have a great incentive for our members to receive a discount on their AMA Queensland membership. You can refer a member and receive a 25% discount on your membership rate for the following year if you refer a member who successfully joins. Terms and conditions can be found on our website. We've got a couple of great speakers tonight. We have Sav and Nicole, both partners at Cutcher Neale, and they will be taking us through end of year tax planning, key deductions you should know about, 2025 budget updates and what that could mean to you, superannuation tips that can help increase wealth in retirement. Please welcome Sav and Nicole.
Good to be here tonight, everyone, and to everyone online. Welcome. So, tax time made easy, tax and easy probably don't fit in the same sentence, but we're here to help you through it all. So, as mentioned, I'm Nicole Brown from Cutcher Neale. Sav and myself are based in our Brisbane office here. We have a head office in Newcastle, and we take a lot of comfort out of providing clarity for our clients' financial futures. There's a bit of a spread there of our clients. We're not simply focused on Brisbane, Newcastle, Sydney, which is where our other office is. We've got a lot of clients sitting up and down the East Coast and in many other locations. Sam and myself like to think we're experts in relation to assisting our medical professionals grow their wealth, and part of that comes through legitimately minimising tax. So we spend a lot of time focusing on accounting and tax and superannuation matters and advisory work, restructures and so on. We take a lot of joy out of working with our junior doctors through to retirement phase and so on. So we spend a lot of time with our junior doctors, and we'll be at the Harvey Bay conference as well. We like to think of our 7 pillars for success when we're considering our clients' circumstances. So not simply focused on accounting and taxation matters, but there's income that we earn, there's tax that we need to pay. We're all about legitimately minimising the tax that we need to pay. But then there's an amount of money, there's a surplus that's left. We've got to live, we like to have a bit of fun. It's important when you work really hard. And then is it, well, what are we doing to accumulate wealth throughout our careers and into retirement? And it's also really important that we might be working very hard, but what if something were to happen to us and we were unable to work? So that's more that personal risk and general insurance space. Probably a topical one at the moment. I'm not going to say I'm an expert in the space, but we have a dedicated finance team within Cutcher Neale. We get access to specialty lending for medical professionals. We were talking about Josh earlier from our Brisbane office. So, if you don't think you're getting a competitive interest rate at the moment, definitely let Sav and myself know, and we can arrange for a complimentary discussion with our finance team. Kathy already mentioned, I guess, what we're covering off on this evening. So I'm going to take you through some end of financial year tax planning, talk about some key deductions, give you a bit of a brief overview of the federal budget. We mentioned that we would talk about that topic well before the federal budget came out, but we'll give you a little bit of an overview on that. And then Sav's going to finish off in relation to superannuation and some top tips, and then we'll go through some questions. We're always very conscious of ensuring that those that are at risk or where income's being generated and so on, so whether you're the medical professional, it could be a medical practice that's being carried on, or maybe your directors, secretaries of companies and so on. It's really important that the wealth that we're building up, you can see my tacky barbed wire fence there, it's really important that we're protecting that wealth as it's accumulating from the beginning and throughout your careers. Superannuation funds, so that's SMSF, self-managed superannuation fund, family trust, investment companies are a very, very easy way to protect your wealth as it's accumulating. We know there's lots of different legal structures. We're there to provide that insight to our medical professionals, AMA Queensland members in relation to what's the difference between all of them, how does the tax rate vary, what type of protection is provided. It ranges from, it could be a very simple, low complexity for a sole trader through to something that's, more complex when we arrive at companies, unit trusts, and other types of trusts. So the main thing is that you're aware of the legal entities that do exist within your structure, and that you understand the roles and responsibilities that come with those legal entities. Here we put forward it's our best practice medico structure. We've got our medical professional that's usually a sole trader. They're paying a service fee to a service entity that typically they have an ownership interest in. Ideally, there's other doctors that are also utilising the services at medical practice, a team of administration members, nurses and so on, supporting the doctor in their role of seeing patients. And then we love the opportunity to invest in the property, whereby we're carrying on the business activity. I'm not going to suggest I'm an expert in the property space, but we know and we've seen time and time the wealth accumulation in terms of real property. So whether that's residential or commercial property, not all investments are great decisions in that space, but more frequently than not, we're seeing great returns over a significant amount of time where the rooms are actually held in a tax-effective environment, which is, we love superannuation for that, but that's not always the right outcome for everyone. So it's really important that you understand your structure. We're all about legitimately minimising tax, and we'll step you through a little bit of that. But it's key that you understand your structure before you even start to think about the key tax considerations. And we're always focused on ensuring that your structure is appropriate and providing tax efficiency and asset protection. And just because your structure might be what it is today doesn't necessarily mean that that's what it should be in 12 months' time. Circumstances do change across every single client. The way they start out in private practice may be very different to how they end. So the benefits of tax planning. So why is it really important at this time of year to consider, well, what income has been earned for, say, the first 9 months of this financial year? What expenses have we paid out? And what profit do we have available that we're going to likely have a tax liability that's sitting there ready to be paid at some future point in time? We know when you're lodged through a tax agent, there's concessional due dates where we still have time up until the 15th of May to lodge the tax returns for the 2024 year. But more so the focus at this time in the year should really be on, well, what's actually happened in the first 9 months? Do we think that's what's going to happen for the final 3 months? Okay, I don't want any nasty tax surprises because I want to make sure that I know what funds I have available sooner rather than later to do something with. So it could be you want to go and buy another investment property. Maybe there's debt that you want to reduce, but you're not really sure what loan to actually direct that towards first. Is there a share portfolio that you want to invest in, and so on. So that's where having a look at what's happened year to date in current time allows you the opportunity to think about what can I legitimately do prior to 30 June to make a decision to reduce the tax that's going to be paid. It's not all about tax. It's also really important that you're considering, well, what happened last year compared to what's happening this year. How do my expenses or overheads, if I'm running a medical practice, compared to the actual gross income that's being generated within that medical practice? Possibly gross fees have substantially increased, so therefore maybe wages have gone up, but in proportion to the income that's been earned, maybe it's okay. Or maybe we've had a decrease in our gross fees that are being generated and our wages have significantly increased. What's going on in that space? So it's an opportunity to reflect on that too. I mentioned assist with, future cash flow, understanding what have I got available to do something different with. And we like to think of it as that personal check-in, going, well, what are my short-term goals, long-term goals? Maybe year on year we're sitting there and doing the same thing and that's okay, or maybe there's opportunities that we're missing out on. When we think about end-of-year planning, here's a few of the matters that we're focused on considering. So it's what deductions are available. Are we making sure we're withholding the information to claim a deduction? And I'll go through some of these in a little bit more detail. Plant and equipment, have we had to buy new plant and equipment, and what does that mean from a taxation deduction perspective? Did we know that there's an option to prepay some expenses the closer we get to 30 June and actually claim a deduction in this financial year as opposed to the next financial year? Sav's going to talk in a little bit more detail about maximising your superannuation. There's an annual limit of $30,000 and there's a carry forward concept that Sav's going to talk you through. But if you're not maximising that, you probably really need to question that and work out if there's a benefit there for you. We like debt. Debt creates opportunities, but we like to think there's good debt and bad debt. So bad debt is when we're not getting the tax deduction for it. So is there any way to increase our good debt and decrease our bad debt and have that work for you? Even more important in an environment when interest rates are fairly high still. If you've got employees, consider paying your superannuation the middle of June to actually get a tax deduction in this financial year as opposed to that falling into the next financial year. Accounting software solutions do all have their own hard cut-off. We spend a lot of time in Xero. Their date varies year to year. If you pay it through Xero, Auto Super by around the middle of June, you're probably feeling very safe that it should clear. It needs to actually make its way through the clearinghouse, and don't understand why, but there's significant timing issues with that actually clearing. So don't try and do it on the 27th of June. There's the income protection insurance I mentioned at the start, that it's important if you're working hard that you're protecting the income that's being earned in the event that you're unable to work for a period of time, to have that replace some of the income, and that will cover the super carry forward deductions for superannuation. In terms of work-related deductions, so at a high level, what you need to be focused on is, if I consider the income that I'm earning, any outgoing associated with that income should be tax deductible to you. And it might be in relation to business income that's being earned, or maybe investment income, and there's different subscriptions and so on that you're paying and whatever else. But I guess a very simple concept is, what income am I earning, and can I claim a tax deduction for this? There's some examples there of, I say, the typical deductions that we see for our medical professionals. It's important that receipts are kept throughout the year and stored safely. We've got plenty of clients that actually send their deductions to us as they're paying them throughout the year, so it's off their plate, it's on ours, and we've got the appropriate records when we get to the end of the financial year. I mentioned a moment ago that you're eligible to claim that tax deduction for expenses that relate directly to income. However, important to understand that maybe there's a pro rata deduction that's available. So it could be that you've paid for something that you think, well, it doesn't 100% relate to my work activity. However, there's a proportion of it that definitely does. One of the typical ones that we see is in relation to conference travel. And, you know, the AMA conference that's on in Canada is coming up, and where there's conference travel that's directly related to the work that's being performed, there's a tax deduction associated with that. And, you know, the conference component, as well as if the predominant purpose to travel overseas for that conference, if the predominant purpose is to travel overseas for that conference, then those airfares will be tax deductible. However, what if I'm going to beautiful Canada and I want to go to the conference for 1 week, and then I'll also want to go and do 3 weeks worth of personal travel? It doesn't mean there's no tax deduction for the airfares, but what it likely means is that we have to consider a pro rata tax deduction for that airfare. So don't just discount it because there's a private component to it. It could be that you paid for something and maybe there's a private component. So definitely ensure that you're raising it with your tax agent, your accountant, because there might be part of a deduction that you can actually get. Claims for kilometres travelled. Important to remember that any kilometres that are travelled in your personal vehicle, tax deductible. If it is salary packaged through a novated lease, you unfortunately can't claim a tax deduction because you're already getting the tax benefit as part of the novated lease. You can claim up to 5,000 kilometres at the set ATO rate. The alternative is a logbook percentage. For employees, it's really difficult to get a high logbook percentage because typically you're driving from home to the same hospital each day, and that's viewed as private travel. However, for those that are carrying on a business activity, it might be that there's some employment income with also some private practice income and so on. It might be worth your while doing a logbook just to determine if I can get a better tax deduction out of it. Work-related equipment, Maura, did you know that anything that's purchased for over $300 if you're an employee in the hospital system needs to be depreciated over multiple years? So you can still have the tax deduction, but it just spans multiple years. Quite different to if you're carrying on a business, so it could be through maybe you're a sole trader with an ABN, or you've got a company or trust that you're carrying on a business activity through. There's some different thresholds that come into play, yet to be legislated. It's been talked about a lot that businesses should be entitled to an immediate deduction for plant and equipment purchased up to $20,000. Every single year we stand here at this time of year and talk about what that limit is for the current year. Last year I think we found out around the middle of June what that amount was that we could claim an immediate deduction for. So it's highly likely it's going to be that amount, but yet to be legislated. And then also if there's a computer or something that's purchased and there, again, there's a private use component associated with it, there's still a tax deduction that can be had. We've just got to nominate a private percentage for that. I mentioned the prepayments earlier on. So for example, you might have a subscription or possibly insurance that's invoiced prior to 30 June. Maybe it's not due for payment until the middle of July. You have an opportunity to pay that insurance amount or the subscription prior to 30 June and claim a tax deduction in this financial year. I mentioned about the employee superannuation if you're carrying on a business activity. It needs to be paid for by the 30th of June to get a tax deduction in this year. And I covered off on that immediate deduction for plant equipment. What if you own an investment property? We like to challenge our clients on purchasing an investment property. We keep hearing all the time about the proposed growth in property through to 2032 and beyond within Brisbane, and we see the stats for other states too. So definitely an opportunity to consider, well, what would an investment property look like within my wealth profile? For those that hold an investment property, it's important that you consider the repairs and maintenance, the interest that you're paying. There's land tax, insurance and rates that are deductible. A key one that we probably see missed quite often is a depreciation report. So if you buy a property that's less than 40 years old, is typically where we'd start. It could be worth your while getting a quantity surveyor to complete a depreciation report, and they go in and assess the value associated with all construction costs and so on. And there's a legitimate tax deduction that you can get for the construction costs associated with the property. The other one could be that maybe the property is of an older age, but there's been some significant renovations and so on that have happened within the last 40 years, and it could still be worth your while getting that report completed. And why do we like investment properties? One, because it helps you build up your wealth within your own net wealth scenario, but negative gearing might work quite well for you from a taxation point of view. And what does negative gearing mean? You consider the income that's earned on a rental property, deduct the costs associated with it. My example there just has an investment property that has rental income of $39,000 for the year, a few other expenses in rates, insurance and so on. We put some tax depreciation in there, and let's assume there was $1 million loan on the property at a 6.5% interest rate. We get a deduction for the interest. So it's the deficit or the loss associated with it is the $36,000. However, there's a tax saving that you get the benefit of. So what you've got to do is weigh up, though, if I'm considering buying an investment property, what's it going to cost me from a cash flow perspective? Because that's really, really important. You don't get a tax deduction for the loan payments, you get a tax deduction for the interest that's being paid. And then how does it work for me longer term with the proposed growth in property and so on. Bucket companies. So bucket companies is a concept that we use here at Cutcher Neale. Other terminologies, it could be a corporate beneficiary that sits within your family group, within your structure. So what is it and how can it work for you? So it's a private company that's established. So it's just got the fancy name of the bucket company. But really what it's about is if you've repaid your home loan, which is a really important one, you've got to be very careful if you have a company that sits within your group structure and you're drawing money from the company and not paying tax on it. There's some special tax legislation. So for this example, let's assume we've paid our home loan off. We might be running a medical practice through a trust and we've got surplus cash flow and so on. How is it that the bucket company might work for you? So in this scenario, I've assumed that there's profit distributions that can come out of a medical practice. And that medical practice is operating through a trust. Now, within a trust has to distribute its income year on year to beneficiaries or it pays tax at the highest marginal rate. So we distribute the income out and let's assume that there's $100,000 that's coming out to, maybe it's the spouse that's not working at the moment. It could be one's the medical professional, the spouse possibly isn't working, and there's a medical practice in play. The profit of $100,000 might come out. There could be some other income and so on, and we're paying 47% tax. So what does that mean? On $100,000 of profit, it means after we pay our tax, the individual has $53,000 available to reinvest. Whereas if that $100,000 came out to a corporate beneficiary that's paying tax at 25%, you can see there year on year, we end up with substantially more to reinvest. So based on these projections, after 10 years, I've got a net benefit of over $300,000 when I consider what that reinvestment strategy looks like. What you've got to be careful with though is, okay, within my bucket company, I'm building up a lot of money. So you need to have an investment strategy in place within that company. So it's just a concept to go, if you've got a business activity that's being carried on through a trust and you've repaid your home loan, it's well worth considering whether a bucket company or corporate beneficiary could work for you within your family group. We've assumed an earnings rate there of 5% on the reinvestment of funds, just for example's sake. Record keeping is really important. I mentioned everyone's got their own way of retaining records. It's really important to ensure if the ATO were to come and ask a question about the deduction that's being claimed, that we've got the evidence there. So it's great if you've got the receipt. In lieu of that, if you've got the bank statement, it's got the clear reference of who you've paid and what amount it was for. You must have spent the money yourself and you weren't reimbursed. The key one that we constantly chase clients for is for a notice of intent to claim a tax deduction for super contributions. There's really strict timelines that come into play. So it might be that you've topped up the super to claim a tax deduction. There's a timeline whereby we've got to lodge that notice of intent within your superannuation fund. If you have a self-managed superannuation fund, so that's where you're managing your superannuation yourself, it's a bit easier to achieve as opposed to an industry fund where your superannuation might be getting paid. And another key one is if you do have trusts that operate within your group, for a distribution to be effective from a trust, it definitely needs to be documented by 30 June. Not in March when you do the end of the year financial statements for the year before. From a budget updates perspective, there were some reforms associated with incentive payments, urgent care clinics, trying to promote the health workforce and so on. Probably one of the key ones that we're thinking about within Cutcher Neale, and yet to model this based on what was proposed in the budget, but understanding the cost of a consult if I own and operate a medical practice, like what does that look like with some of those changes that are proposed with incentive payments and so on. I mentioned the incident asset write-off of the $20,000 threshold. Like I said, yet to be legislated, but we should hear about that shortly. There is a reduction in tax rates for individuals that I'll show you shortly. Again, if you're at the highest marginal tax rate, there's no significant change. It wasn't really mentioned in the last budget, but just a general reminder that for some time now we've been increasing our compulsory superannuation for employees from 9% through to 12%. The final increase happens from 1 July. They didn't talk about any other increases at this point in time. We know those that work within the public hospital system are entitled to 12.75%, and then there's that option to package more. But I've got there more to come with the federal election this weekend, so we'll see what comes of that. Some slight tax decreases there. It's more so in the lower marginal tax rates, but it cascades. The 16 cents for every dollar will decrease to 15 cents and so on. So not too much exciting news to do with that for those that are in the higher marginal rates of tax. I'll now hand over to Sav to take you through some superannuation aspects, and then we'll come back to question time.
Thanks, Nicole. Superannuation, as you know, most of you will be in a fairly high tax rate as individuals. 47% is the highest marginal rate. In a superannuation fund environment, the highest tax that the super fund will ever pay is 15% on its own earnings. Now, contributions can be a little bit different, and depending on whether I'm sort of jumping ahead here, but the Division 293, so if you're a high income earner and your income is over $250,000 and you make contributions, then as well as the 15% contributions tax, there's an additional 15% tax on those contributions. But as far as the actual tax rate within the fund on its own earnings, 15% is the maximum. So a very good tax structure to help save some tax. A superannuation fund is another form of trust, so it can actually provide very, very good asset protection. So if you've got an asset that you really want to try and lock down and secure and keep it safe from creditors and so on, a superannuation fund, depending on whether you buy something with the super fund's money itself or whether you make contributions to boost it up and so on, as I said, it's another form of a trust that you can put an asset into. You do need to keep in mind, though, that the money that goes into super can be fairly difficult to access because of retirement timeframes, being over age 60 and being able to access it. But for those of you that do have self-managed funds, obviously there are other ways to access those if you're buying business real property and so on, for example. As Nicole mentioned before, the superannuation guarantee rate increases to 12% come 1 July, but the public hospital employees are already getting 12.75. So at this stage, there has been no further announcement of any changes to that rate, but you can put in additional contributions if you like. I mentioned the Division 293, which is paying additional tax on contributions if your income is over 250,000. You've also got to be careful of excess contributions, so where you go over your caps. There are a couple of different options. So if you've exceeded your caps for the year, there are ways of electing to have that refunded to you. What you need to be careful of is if you exceed both your concessional contribution cap and your non-concessional contribution cap, then you're going to be paying 45 cents in the dollar. So you really want to try and avoid that, because then there's pretty much no benefit of having it in the super environment as opposed to keeping the money in your own name where you're paying 45% plus Medicare. Keep in mind also the compounding effect of having something invested in the super environment where your tax is very low, depending on the sort of earnings and growth you're getting within the fund, that you can have higher rate of growth where you've got a much lower tax rate. So Nicole did a comparison before of having money invested in or profits invested in an individual name and tax, and then comparing it to a company. Well, if you compare that to a super fund at an even lower rate of tax, now I'm not talking medical trust distributions or anything like that, but I'm just talking about the compounding effects of having an investment in a super fund environment. So the lower the rate of tax, the more you're going to be left with at the end of the day. These are the current limits as of, or in this current financial year. So we did have an increase in the concessional contributions cap to $30,000. The non-concessional cap is essentially 4 times that. So every time there's an index increase to the concessional cap, the non-concessional cap changes as well. So that's 4 times, so $120,000. Or if you're in a position to be able to put in 3 years worth in advance, then you can put in $360,000. So I guess a bit of a strategy, if you had a big chunk of cash that you wanted to get into a super fund very quickly, then you could look at putting something like your $30,000 and $120,000 in as a non-concessional before 30 June, and then come 1 July, you trigger what we call the bring forward for 3 years, and you can put in another $360,000 then, and you've put a whole lot of cash into your super fund in a very short space of time. But you need to be careful then that, again, with those contribution caps, that you don't then do anything to trigger a breach of those caps, and then you end up in an excess contribution position. So yeah, the comparison there, the 15% tax in the superannuation environment, or 30% depending on if your income's over $250,000, as opposed to your personal rate, which in most cases will be 47%. Nicole mentioned this one before, the superannuation guarantee rate changes to 12% from 1 July. Most accounting software these days handles that sort of automatically. So if you're using something like Xero or Mile, it's already built in to the system where it will automatically change. Days gone by, you used to have to update tax tables and rates and things manually, and people would not do that, and you get caught out. Now it's not so much of an issue. Carry forward unused concessional contributions. So this is quite a handy benefit to increasing the amount you can get into super that was introduced only in the last few years. And if you have a total super balance of under $500,000, it was an incentive, I guess, by the government and the ATO to say, well, let's help you get more money in sooner, especially if you, I guess, have been in the workforce a while. Also to say working, non-working mums who are re-entering later in their career and want to build up their super. You have the ability to look back 5 years, and any of the contribution caps that you haven't utilised over that time, you can catch those up. So they do drop off every year. You look back sort of a rolling 5 years. The one thing to keep in mind though is if you want to access your unused contributions from previous years, you need to maximise the current year contribution first. So you need to have maxed out your $30,000 in the current year, and then if you do make extra contributions, then they start, or the ATO automatically deducts them from the oldest of the available 5 years, and then takes them off in, going, I guess, forwards from there. So yeah, parental leave, returning to work. If you've got a one-off large income year, so let's say you've made a capital gain on an asset, whether it's an investment portfolio or a rental property, and you're looking for a big tax deduction because you don't want to pay a whole lot of tax in that particular year, then if you've got the opportunity and your total super balance is under $500,000 and you still have some available room in your catch-up contributions, then you might be able to put in $50,000, $70,000, $100,000, for example, and reduce your capital gain by that. So it can be quite a good planning strategy. And if your income is constantly increased, let's say, and you're on a salary, and when you get a bonus, or your income keeps going up each year, and you've got some surplus cash, another good strategy is to put in some additional contributions there. Here's a bit of an example. So this is someone at 33 years of age, I think typically on about $180,000. If they're to maximise their cap and use the full $30,000 each year, or put in the full $30,000 each year, and this is assuming a 5% earnings rate, the difference can be over $700,000 by retirement age. So if you do have the available cash, and when you break it down, it's only really about $129 a week after tax, so it's not actually a big amount. Something definitely to keep in mind, that you can boost your super quite dramatically. $700,000 would probably make quite a difference for a lot of people when they hit retirement age. One of the services that our investment services team offer is a comparison of how industry funds perform, and we've got a bit of this is a fairly recent update, comparing a few of the major ones like Australian Retirement Trust, Aware, Q Super and Australian Super, and these are what we call their balanced portfolios. So you can see what they've done over the last about 5 or 6 years. You'll be interested to note as well that the sort of maroon coloured one up the top is actually our own in-house retail super offering. So we have a number of in-house portfolios, both in the super space and non-super space. So we run some model portfolios, one being the Australian shares model, which is invested in about 30 odd Australian stocks. Then we have an international shares model, which again is about 30 international shares. We have a fixed income model, which is a more conservative sort of offering. People that would typically be attracted to things like term deposits would be interested in something like that because it's a lot more defensive and capital. Then we have an alternatives model, which, as it says, invests in things like that are alternative, like private equity and things that are a little bit different, I guess. And our positive impact model, which invests only in companies that have a lower impact on the environment. So what we typically do then is when we work with our clients on an investment strategy is we go through our risk profile questionnaire with you. We understand what your level of risk aversion or awareness is. And then from there, you answer a number of questions, which sort of gives you a score. And from that, we then determine whether you're a conservative investor, a balanced investor, a high growth investor, an aggressive investor, and we can structure things around that. So as you can see there, our in-house Cutcher Neale balanced fund in the super space, our retail super offering, actually did really well compared to a lot of the industry funds. A lot of people will often start with an industry fund when they get their first job in the public hospital system, and then it's a bit of a set and forget. It's like, yeah, I'm putting in 12.75%. It looks like it's doing okay. And then 20 or 30 years later, they approach us and they say, oh, I actually thought I'd have more in my super fund by now. And we say, well, your fund actually hasn't been performing that well, but it's not too late to change. And so from that point of view, we have had a number of clients that say, well, let's get into our retail offering. And obviously we have to do a full statement of advice because it is a financial product that does come at a cost, but we do a very extensive review of your overall position. So we go through that risk profile questionnaire, and from there we put you in what we'd like to think is the right investment strategy. And we have a dedicated team that basically all they do every day of the week is sort of look at the stock markets and do a lot of research. We have an in-house chief investment analyst and another researcher and a planning team behind them. We have regular investment committee meetings, so we're constantly watching the markets. I know recently with everything that's gone on in the States with Trump and his tariff impositions, there's been a lot of activity in our portfolio reviews, and we've basically tried to look at every single stock that has had some impact by tariffs. So even though it might be an Australian company, if they're doing a lot of their production in, say, China or Korea or something like that, then we've actually trimmed our holdings on that. So we've gone to a bit more of a cash position and we've reduced our exposure on some of those particular companies just to try and, I guess, stay ahead of the movements in the market. Some year-end tax planning tips. This is what we'd like to think about. We'd like to call our top 10. Think about the future now. It's never too early to start thinking about investing. Those of you that have been in the game for a while, don't stay static. It's something that you should be reviewing constantly. Don't be driven by the tax deduction. Your highest marginal rate of tax is 47 cents on the dollar. If you have to spend the money anyway and you will get a tax benefit for it, great. But don't say, well, I'm desperate. I just want to spend it because I'm going to get the tax deduction. Don't do that. Don't look at it that way because ultimately you're still going to lose 53 cents in the dollar in real cash flow compared to what you're actually getting in tax benefit. Understand your structuring. Make sure you've got the right structure from a tax efficiency point of view and make sure all of the financial arrangements behind that align with that structuring. Understand your tax position. A good advisor should be able to tell you exactly where you're at and also tell you what's coming in the future. And that's where our tax and strategic planning really comes in handy, I guess, because our clients know before they get to 30 June what tax position they're in and what changes need to be made. And so, whether you then want to make an investment in something or whether you just need to budget for that extra tax, especially if you've just gone from being an employee to working as a sole trader, and all of a sudden you've had a tax holiday because the tax wasn't deducted for you by your employer, or like it was by your employer previously. You need to make sure you've got that tax available in cash flow. Consider prepayments. Look at paying anything you can before 30 June instead of after 30 June. Nicole mentioned some of those before, whether it's things like income protection insurance, subscriptions, memberships. Are you looking at any courses that you can pay for now and book your airfares and accommodation in advance? Can you prepay rent for your premises? Can you prepay interest on your loans? There's a number of different things that you can do. So if you're going to have a year that you expect is going to be a fairly high tax year, look at doing some planning beforehand. Do you need any brand new plant and equipment? Again, not knowing what the change is going to be into the instant asset write-off. Is it going to stay at $20,000 or will it go back to $1,000? If you're looking at buying anything in terms of bigger equipment now, do it before 30 June. Don't wait until after 1 July. Understand your different finance options. We do have a changing interest rate environment. There is an expectation that we may get a reduction next week when the Reserve meets next week. Compare or think about good debt versus your bad debt. Try and minimise your bad debt on your personal home, which is non-tax deductible, or say credit cards and things like that, and try and think about maximising the good tax deductible debt. Make sure you pay your superannuation on time. So employees, again, watch those cut-offs. To get the tax deduction pre-30 June, it needs to have hit super fund pre-30 June. So with the payroll software, yes, there is a bit of a delay through the clearinghouse, so make sure you take that into account. Have a think about your insurances. When did you last review your insurance policies, whether it be your home or your car or your medical indemnity or your business, your management liability, those sorts of things? When did you last review those? Are they just something that you constantly renew without thinking about it, or do you get them reviewed regularly to see if you can save money on something? Are you paying insurance on something that you don't need? Does your business pack policy cover a $100,000 machinery breakdown when the only thing you've got in your rooms is a $3,000 vaccine fridge? If there's anything that you're unsure of with anything that we've covered, feel free to reach out. As Kathy mentioned before, we do offer a complimentary consultation. Contact Nicole or I and we can sit down and have a chat with you. Advance it on the screen there. Just for those online, we're just having a couple of technical issues. Okay. Sorry, go back one. Thank you. It's a little bit sensitive. Okay, here's some contact details for both Nicole and myself. And on the right-hand side, there's some QR codes for those that are interested. We've got some checklists for end of financial year, whether you're a sole trader or whether you're running a practice. There's a couple of different checklists that we can take you through. Okay. Just I guess a prompter for an upcoming seminar that we've got. It's called Build Wealth Through Property. This is actually done or run in conjunction with our finance team and a property buyer's agent. So this is coming up soon. I don't recall exactly what date, but
It's late May.
late May.
28th of May, maybe.
Okay.
Yeah.
Anyway, if you scan on the QR code, you'll get some more information. But as I said, it's run by a finance team and a property buyer's agent. There'll be some really handy information for those of you that are interested in building wealth through property. It's just our usual disclaimer. And I think that's about it. So